Happy Friday, everybody. I'm Jerry D'Ambrosio, and welcome to this week's special presentation. Dividend investing holds significant importance for investors seeking a stable and consistent income stream. Companies that regularly pay dividends often exhibit financial stability and a history of profitability, signaling a sound foundation for long-term growth. Dividend payments can provide investors with a reliable source of passive income, enabling them to weather market fluctuations and economic uncertainties. Additionally, the compounding effect of reinvesting dividends can contribute substantially to overall portfolio growth, making dividend investing a valuable strategy for both income and capital appreciation. This quote was taken from Dr. Leto's book, Stock Strategies and Common Sense. This is the new version, page 60, and you can find this downloadable version right within the training tab of VectorVest 7. He said, the best of both worlds, collecting dividend checks while prices of your stocks go up, comes from finding solid growth stocks that pay dividends. VectorVest is ideally suited to find these babies. And that's what we're going to do today. We're going to go through a few exercises in finding solid dividend stocks that you can rely on year in and year out. But before we do that, we'll go through some basic terminology first. First, what is a dividend? A dividend is a distribution of a portion of a company's earnings to shareholders. Dividends can be issued in various forms, such as cash payment or direct deposits. Dividend yield, just simply the amount a company pays relative to its share price. And dividend yield is just the annualized dividends per share divided by the price per share. Now, these are basic dividend terms. And here are some other important terms that every dividend investor needs to know and understand. First, the declaration date. This is the date on which the company announces the next dividend payment amount. There's the X date, the date before which you must own the security in order to receive the dividend. The record date, the date on which the company ensures the dividend is paid to shareholders. And then the payout date, the date on which the payments are made. And again, this can come in a couple of different forms. They can mail you a check or directly deposit the dividend payment to your account. Within VectorVest, we have two flags, if you will, or two markers on stock charts. We have the X date and we have the payout date. Remember, the X date is the date before which you must own the stock in order to receive the payout. So here with Parker Hannifin, X date was just recently, November 10th. You notice we don't see a payout marker there yet. They haven't paid the dividend. Should be any time now. Usually the X date is a few weeks before the payout date, and that's generally. Now we'll get into some VectorVest proprietary dividend analysis indicators. First is dividend safety. Very important dividend indicator here. It's an indicator of the assurance that regular cash dividends will be declared and paid at the current or higher rates for the foreseeable future. Scaled between 0 and 99, DS values above 75 typically have RS values well above 1 and earnings yield levels that are much higher than dividend yields. So one of the things that we don't want to do is we don't want to chase yield. They're enticing, very attractive when you see a stock's dividend yield at 8, 10%, maybe 12%. It's a little misleading there. So we want to make sure that we're doing our due diligence and looking at the bigger picture and not chasing yield. And I think dividend safety is a very important indicator. This again assures that you will continue to get paid every quarter, every year at the same rate or higher. One of the worst things that can happen to a company is that they either cut their dividend or reduce their dividend. So big black eye for the company if that ever happens. And we talk about managing longer term investments and much different than managing trades, right? Shorter term trades. When you're managing a longer term investment, you might look at things like recommendation equals sell as an opportunity to sell that longer term investment. We also say if a company's fundamentals start to break down, that might be a situation where you look to, cut that investment loose, break ties with that company. And this is a part of it. If a company's fundamentals begin to break down, if they begin to reduce their dividend or cut their dividend, big black eye for the company, and you may want to move on. So this indicator, very important. Dividend growth, just a forecasted annual growth rate of a company's dividend based on historical dividend payments and dividend predictability. And then finally, YSG combines the dividend yield, the dividend safety, and the dividend growth into one comprehensive indicator, very similar to VST in that it is scaled on a 0 to 2 basis. And it's an indicator that combines DY, DS, and DG into a single value and allows direct comparison of all dividend-paying stocks in the database. Stocks with the highest YSG values have the best combination of yield, safety, and growth. There's also what's called DRIP. DRIP is a dividend reinvestment plan offered by companies to shareholders, and it allows them to reinvest dividend payments directly through the company. They offer fractional shares. You can buy full shares, of course, but they do offer fractional shares. You don't have to go out to the open market to buy them. The dividends are automatically reinvested through the company. They'll also, to shareholders, offer discounted share prices as well, and these dividend reinvestments are commission-free. With the DRIP plan, you do not actually receive the dividend, but it does still need to be reported as taxable income. So I'm going to hop right into the VectorVest program, and a couple of different ways to find dividend-paying stocks. I'm going to go into the viewers, and we have a watch list folder here called dividend payers. And you can see we have a couple of DRIP watch lists here. We have monthly dividend payers. Normally dividends will be paid quarterly, but there are companies now that do pay out monthly dividends. I'm going to jump right to the DRIP 25 plus years. So all the companies here, there are 136 of them, participate in DRIP plans. They allow you to automatically reinvest dividends into the company, which again compounds returns over time. Additionally, the more shares that you buy, the more dividends that you reinvest, and the more shares you accumulate also pay dividends along the way as well. Right? So you're compounding returns and growth over time by reinvesting dividends automatically. And the 25 plus years just simply means that these companies, again, 136 of them, have increased their dividend every year for the past 25 years. So I'm going to move us over to the right, almost in the middle here of our watch list spreadsheet, and you can see where our dividend analysis lies. So here, again, we have the dividend, DIV, that's the annual dividend paid. Essentially, what this number is the last indicated quarterly payment multiplied times 4. Now, if it's a monthly dividend payer, we multiply it by 12 to come up with that annualized dividend number. So almost about $6. You're looking at about $1.50 or so, a little bit less per quarter, roughly. Then you have the DY, which is a reflection of the share price. So dividend divided by the price of the stock gives you a 1.37% dividend yield. Then you have the dividend safety, dividend growth, and YSG. We talked about what these indicators are. Let's talk about their values. Dividend safety, again, is on a 0 to 99 scale. So at the top here, you have some strong dividend safety stocks. Dividend growth is a annualized percentage increase in that dividend on a yearly basis. Essentially what this is a pay raise, right? So we're forecasting Parker Hannifin to grow their dividend 14% next year. Renaissance, Granger there, 9% next year, 12% respectively. So you're looking for a well-rounded dividend-paying stock, but you don't want to chase yield. So, for example, Parker Hannifin has a dividend safety of 89, very good. One of the things that this indicator looks at is the payout ratio, is the difference between the earnings yield and the dividend yield. Earnings yield at 5.22%, they're earning $22.52 per share. They're paying out, and again, that's annualized, that's our leading 12-month earnings per share. They're paying out per year $5.92. So that's what you want, right? You want companies that are earning more than they're paying out, which is one of the factors determining dividend safety. The other is relative safety. So what you'll generally see with high DS stocks is a favorable payout ratio, earnings yield greater than dividend yield, and an RS rating well above 1. And you can see that's the case with most of these stocks at the top of the list. Let's take Bank of Ozark, for example. Okay, so RS a little bit below 1 there, 0.95. It's undervalued. Got a good earnings growth rate at 20%. Earnings yield 14%, dividend yield 3.5%. But look at that dividend safety. It's at 63. Still pretty good, But this exercise here, guys, I want to get you to start thinking about some of these things when looking for dividend-paying stocks. And remember, you don't want to always chase yield. A 3.5% yield is enticing, very attractive. If their earnings hasn't been as consistent and predictable as you'd like them to be, do you have reassurance that they will continue to pay that dividend at the same rate or higher going forward? So I'm going to look at something like Parker Hannifin. Dividend yield at 1.37%, not too shabby. 89 dividend safety, we're forecasting them to grow 14% over the next year. Renaissance, dividend yield a little bit less than 1. I know it has a good safety rating. Good payout ratio, earnings yield compared to dividend yield. It's got a YSG of only at 1.05. I know this is favorable, but it's on a 0 to 2 scale. We like that number to be a little bit higher. Dividend growth, 9%. That's good as well. Good RS at 1.16. Earnings growth rate at 29%. Dividend yield, not as high as maybe you'd like it to be. So you continue this exercise. Let's take a look at AOS. Dividend safety, 83. That's very good. Dividend yield over 1%, 1.69. Payout ratio favorable. RS rating well above 1 at 1.30. Now we're cooking. YSG 1.11. Continue to scroll down the list. Aflac, juicy yield 2.5%. Earnings growth rate only at 5%. So something with earnings growth rate you want to consider. Make sure the GRT earnings growth rate equals or greater than the sum of current interest rates and inflation, which right now is about 9% or so. So earnings growth rate at 5%, juicy yield at 2.43%, nice payout ratio there, earnings yield greater than dividend yield, good dividend safety, good RS at 1.37. So Aflac looks to me so far like the best stock in this list, apples to apples. It's got a YSG of 1.21. You can also sort the list by YSG as well. Now you might not get the highest dividend safety scores at the top, but you're going to get a very well-rounded dividend-paying stock. A lot of these yields are very high, though. Dividend yield at 9.52%. Also, the higher the yield, the less likely it is that the stock will continue to pay that dividend at the same rate or higher for the foreseeable future. So generally with these high-yielding stocks, you're going to have lower DS scores. You can just sort by DS as well. It's the beauty of a watch list. You can sort by any indicator here. So if you sort by DS, all of them at the top are going to be 99s. Look at the yields, though, rather low. That makes sense, right? The lower the dividend, the less they pay out, the more likely it is that they're going to continue to pay that moving forward or higher. Remember, dividend safety is not only looking at the current rate, but the likelihood of the dividend increasing over time. Keep coming back to Aflac. Dividend safety of 88, yield at 2.5, good YSG, and a very good RS score. So just a few things that you may want to consider when going through any list of stocks looking for solid dividend payers. You don't have to do that every day. I just wanted to get you folks thinking about the indicators that you want to see. I'm going to move us now into the Unis Search tool. And there is a search in the Searches Conservative folder called Pale Blue Chips. Let's take a look at the indicators here and what the search finds. First off, the search is sorted by VST plus YSG. So we're looking at the best combination of value, safety, and timing, and dividend yield, safety, growth. So right off the bat, we're looking for RS ratings to be greater than 1.25. Very good on a 0 to 2 scale. Dividend growth greater than 10%. Again, right now that is the sum of current interest rates and inflation, a little bit higher. So they're growing their earnings at a faster pace than interest rates and inflation. Dividend safety above 50, dividend growth above 10%, dividend yield, we want at least to be 1%. We want it to be worth it, not only to buy the stock, but to hold it. And then just some basic price and volume filters there. So if I go ahead and run that search, let's take a look at the stocks in this list. Broadcom, Selective Insurance, Lennox, there's Parker Hannifin. So let's take a look at some of the indicators. First off, look at all the RS ratings. So RS scores are all above 1. We know that these stocks are consistent and predictable with their earnings performance. I scroll over here. All these dividend yields are greater than 1%. Look at those safety ratings. A big reason why these safety ratings, and again, the search is just looking for them to be above 50, but a big reason why these safety ratings are so high, favorable payout ratios, earnings yield much higher than the dividend yields, and those relative safety scores are well above 1. So you're looking for, again, like Dr. DeLito said, the best of both worlds. Stocks that are rising in price, that show tremendous growth and consistency in their earnings performance. That gives a company a high likelihood that they will continue to pay out whatever they're paying out at the same rate or higher for the foreseeable future. So a great little search here, pale blue chips, to find solid companies, growth stocks. Look at these earnings growth rates as well. So we looked at earnings per share, earnings yield. Look at those earnings growth rates. So not only is Broadcom earning $45.16 per share, we're forecasting to grow those earnings 19% over the next year. They're paying out 1.9% dividend. Again, favorable payout ratio, really strong dividend safety. Those dividend growth rates are all double digits. And remember the sort VST plus YSG. So great search here to find stocks with the best combination of value, safety, and timing. So we want a company with strong fundamentals, and we want them to pay a good dividend as well. So dividend investing is not only important for folks in retirement, but investors who are just looking for a steady, passive income stream on stocks that are currently in their portfolio. Hope everybody had an enjoyable Thanksgiving, and we'll see everybody again next week.